Hey there, property people. Welcome to the Regional Property Show, where we discuss topics designed to educate and inform listeners on how to get the most from their real estate experience in the Ballarat and surrounding areas. My name is Stu Bryan, and I'm a licensed real estate agent and the owner of Stone Real Estate Ballarat. We're part of a large network of offices throughout Australia with a dedicated team servicing the Ballarat and surrounding community. If you would like to contact our office to discuss anything related to residential sales or rentals, you can call us on 5341 2200 during business hours, or just Google Stone Real Estate Ballarat. That's Stone, S-T-O-N-E, Real Estate Ballarat. Taxation is not a subject that most people get excited about, but an increasing number of people have more than a passing interest in the topic, because of the recent introduction of a range of taxes from the state government that are reaching into the pockets of more and more property owners. The expansion of land tax and the introduction of vacant land tax has many property owners and sellers scratching their heads trying to figure it all out. So, in this episode, I interview a local accountant and partner at Sharp Accounting, Ewen Fletcher, to discuss all of these topics, along with some of the stamp duty concessions available to buyers. As always, the information is general in nature and should not be considered professional advice, and you should speak to your own accountant or legal professional to understand your unique circumstances. Welcome to Ewen Fletcher from Sharp Accounting, and thanks for coming in today, mate. I really appreciate it. We've got a topic that is something that I come across quite a lot, but obviously you come across a lot more than what I do, and it's taxation. So obviously it's not necessarily the most sexy topic in the world, but it is a really important one when it comes to property, because it's one of those topics that people often forget about until it's too late. And so I appreciate sort of you coming in to give our listeners and viewers a little bit of an overview, I guess, from a high level perspective as to the different taxes that people need to be aware of. So Ewan's a partner at Sharp Accounting, full disclosure. Sharp Accounting is actually my accountant. So give us a little bit of the backstory in terms of your background and getting into Ballarat and the area and so forth, and what you've been up to.
Yeah, thanks, Stu. And look, really looking forward to this discussion today because it's quite topical. As you say, it mightn't be the sexiest thing, but it's something everyone needs to know. So, look, my background is I grew up in northeast Victoria, moved down to Ballarat for university and stuck around. And, that, as I say, the rest is history. That was 20-odd years ago. Live in Buninyong now with a young family, 2 boys and my wife. As you say, been a partner at Sharp Accounting for a bit over 10 years and 20 years in the industry. Look, outside of the workplace, I like to give back in numerous ways. I'm involved with Rotary. I've been on a number of boards, including the Chamber of Commerce, so now known as Commerce Ballarat, also the Ballarat Foundation, and then where we met, which was the Ballarat Business Centre.
That's right.
15 years ago.
So we should give a disclaimer too, shouldn't we? I mean, what do you think in terms of we're going to be talking about some topics at a fairly high level?
Yes.
What do you think people should do? Obviously, if anything within this episode is something I want to know more about, what should they do?
Yeah, really good question. We're going to cover a lot of content today at a high level, as you say. When you get down to the nuts and bolts, it's really important that you seek advice from a professional advisor. Now, that might be a lawyer. It could be your local accountant. But in any case, seek advice that relates to your specific circumstances, because nothing that we'll discuss today can be applied directly to your circumstances without that advice. So,
Good. Yep. All right. So this is not financial advice, folks. So just that disclaimer. All right. Well, let's dive in, because there's a lot to cover. And can you perhaps give us a broad overview of what taxes that property owners, sellers, buyers and investors should be aware of?
Absolutely. So taxes really fall into 2 areas. There's federal taxes and there's state taxes. At a federal level, just think Australian Taxation Office. That's referring to the earnings that you generate from your rental properties, whether it's commercial, residential, or it could be the capital gains tax when you sell the property. So that's your federal taxes. And then as we're in Victoria, and a number of the listeners will be, I'll just refer to the Victorian taxes, which is administered by the State Revenue Office. It can be anything like stamp duty, land tax, vacant residential land tax, windfall gains tax, commercial industrial property tax. It goes on and on. There's a lot.
Yeah. There's a few names in there that are fairly new.
Absolutely.
So we will cover some of those a little bit later because they're the things that we're getting asked about a lot at the moment. And it's a topic that seems to be to be coming up a lot in conversations with investors. So we'll drill down into it a little bit more. Can we kick off with capital gains tax, and let's try and get our head around that a little bit, because I find that when I'm talking to sellers, quite often the question they're asking me is, oh, look, how much capital gains tax am I likely to incur? And asking a real estate agent that question is probably not the best place to start. And I don't like to give advice, but at the same time, it's good to have a sense or an understanding of the situation. And I'm sure it's very specific to people's circumstances. So maybe give us a little bit of an overview of what capital gains tax is, how it's applied, when it's applied, whether it has an impact on things like your principal place of residency or inherited property, for example.
Yeah, great question. And we get these questions every day of the week as well. So it's common across the board. Let's start with your principal place of residence. So if you've lived in that property for the whole time as your principal place of residence and you haven't owned another property that you're claiming under that exemption, then there won't be any capital gains tax. So that one's nice and simple. We then move on to the scenario where a property might have been your principal place of residence for a period of time and then you rent it out. And this is the common way a lot of people get into rental properties, is they trade up their house they're living in and they rent out the prior one. If this is the case, you need to obtain either a valuation or an agent's estimate of the value when you move out. And the gain is only a difference between that value when you move out and rent to when you sell it.
So interestingly, I get approached by people to do appraisals retrospectively, 2010, for example, on that property, which is a little problematic at times. But is that because what they're trying to do is get a value in time so that they can then measure against what the value might have been when it came time to sell it, for example?
Yes, absolutely.
And does the tax department, do they see that as a valid way? Do you not need a sworn valuation for that sort of thing?
That'll really come down to the taxpayer, so your client's comfort, how much certainty they want in regards to it. So the norm would be to get an agent's appraisal like what you're providing.
Yeah.
Some people want to eliminate any risk and they'll get a formal valuation.
Right.
I think the main thing is as long as there's data backing it up, then that's a good start.
Can we just unpack that word risk for a second there? So
Yeah.
when you say to eliminate risk, what is the risk?
Yeah, it's a good question. It's just more a case of if the ATO, the taxation department, was to disagree with the valuation,
Right.
you'd have to substantiate where it came from.
Okay.
And they may engage a independent valuer. Now, that would be very unlikely.
I was going to say, has that happened before? Like,
No, it very rarely happens. And for everyday mums and dads that are doing the right thing, I don't think it'll be an issue.
Yeah.
Yeah.
Okay, cool. So what about properties that are inherited, for example? What's the scenario there?
Yeah, look, this is going to be more and more relevant as we get this generational inheritance happening. So what we've got is there's two rules that apply. If the deceased held the property prior to 1985, then the person that inherits it receives market value at the time they receive the property. So in other words, it's only the gain from from the market value to when they sell it, which could be quite minimal depending on how long they hold it.
Okay.
The other scenario, which is probably more common given how long ago 1985 is now, 40 years, is that they just inherit the cost base of the deceased, which can be somewhat troubling to work out depending on the financial records.
Can you unpack that cost base of the deceased?
Yes.
What does that mean?
It basically means the purchase price plus the initial costs for that property. So it could be the stamp duty paid.
Right.
Maybe the deceased built an actual building improvements on that.
Okay.
Yeah.
All right. So if my parents, for example, purchased a property back in 2005 and they paid, let's say, $500,000 for it.
Yes.
Did some renovations to it and then upgraded. Do those sort of things apply in terms of thing, or is it just the actual cost of the property?
No, it's good. Yeah, those improvements would also be included.
Okay.
And this is where it'll come back to record keeping. And certainly if people have got elderly parents that may in time be passing on property to them and it's an investment property or something like that, then it's really important to get an understanding of the history of that property.
So does that mean that they're paying capital gains tax between the cost base and then the current value? Is that the...
Yes, potentially.
Right.
That's right.
So if it sells for $1 million, they paid 500, you pay capital gains on the uplift between the two.
Yeah, that's right. Now, there is, with the states, there's quite a complex area, and there are some rules depending on how long you hang on to the property from the, certainly if it's a principal place of residence for the deceased. There's rules around that, which we won't get into today, but specialist area.
Yeah, so we don't want to go into the weeds of all this, because it will depend heavily on the circumstances. But I suspect that a large number of people wouldn't have a clue how much more money has been spent in property. For example, I don't think my mother would even know how much money was spent on the property. I don't think she'd remember how much she paid for it. I mean, we could find out. So how does an accountant with their client get around like those sort of scenarios? Is it just a case of estimations need to be taken at the time?
It is really complex to try and work out how to undertake it.
Right.
And it's going to become more of an issue as the 1985 sort of an earlier property is no longer really available. As you say, the improvements really, it needs to come back to some records to be able to work on.
Yeah.
Which makes it pretty hard to estimate because of all the costing was different back then.
Definitely.
So even estimates are, not overly accurate.
Is there a flat rate as to what capital gains tax is? Like, is it it's a percentage of the uplift, but what sort of percentage is it?
Yeah, well, I wanted to have a chat about that because there's a real confusion out there around capital gains tax. So if we use a simple scenario, a property that was purchased for $300,000 with all costs included and sold for $400,000 after costs are taken out, there's a $100,000 gain there. That capital gain isn't the tax you pay. That's just an income that goes in your tax return, and then you pay tax at your marginal tax rate.
Right.
Which for the everyday person could be between, say, 32 and 39% tax. So as you can imagine, the other thing I will say, I'll go back one step too. I discussed there a $100,000 gain we're talking about. Look, as long as you own it individually and you've owned it for 12 months, you're only paying tax on half that gain anyway.
Right.
Before it even gets applied to your tax rate. So people get very worked up about and worried before they see their accountant or their advisor around how much is the capital gains tax. But a lot of the times it's not as big as you think, and we can do things to reduce the capital gains tax if we know in advance in the same year that you're selling it.
Okay, so that comes back to planning.
Absolutely.
All right.
Yeah.
And not at the end of the financial year, just 2 days before.
That's right.
More so for when, obviously, when the several weeks or months beforehand, I presume.
Yeah, that's right. Planning so that any work you do and any steps you take to reduce the overall taxable income is in the same financial year.
Gotcha. Yep. All right. So, is there anything else around the capital gains tax we kind of haven't touched on?
I wanted to touch on one other scenario. So we spoke about the idea of having your own property and then renting it out.
Yep.
I also just want to quickly touch on the reverse of that, which is you buy a rental property in time, maybe you downsize, maybe you change, and you actually make that your principal place of residence. If that's the scenario, what happens there, Stu? It's basically just a simple calculation of how many days did you hold it for in total, and what portion was your principal residence, what portion was a rental. That percentage will determine how much of the capital gains is assessable for tax. So just keep that in mind. As I say, the initial one was more common, which is it's your own place and then you rent it.
I do get a number of people who get really nervous about sort of selling a property because of the tax they're likely to incur as a result. But, I guess the theme I'm hearing is, look, get some advice first, understand the situation, because it might not be quite as dramatic as what you think it is, because you need to.
Spot on.
And it's a very complex area, so drill into it, understand it more, then you can make some informed decisions.
Yes, absolutely.
Right. Okay.
Yep.
I've heard this thing bandied around called the 6-year rule. What is this? Have you come across this? Okay,
yes.
It's a thing. All right.
Oh, absolutely. No, it is cool. So look, it's a brilliant thing if you can access it, if your scenario in life works. Look, how does it work? You've got your own principal place of residence. You decide to move out of there, and for one reason or another, you don't purchase another principal place of residence. Common scenario we see is someone relocates for work.
Yep.
They're not too sure whether it's going to be a long-term move. So maybe they're away for a few years.
Yep.
They're just renting while they're away. So the 6-year rule means that once you've moved out of your property, it can earn income. So it can be rented for a period of up to 6 years, and you're not going to pay any tax if you sell it in that period of time.
Gotcha.
So it's still exempt under the principal place of residence exemption.
Okay. So expats, for example, who are living overseas, that come back within that sort of 6-year period potentially.
It was as simple as that until recent years. As the government has, the federal government's meddled with the taxation for people departing and coming back to Australia. There's now a few nuances around that.
Okay.
And that's a specific advice area. But if we talk just to someone staying in Australia,
Yeah.
absolutely can apply.
Okay. But you can't have purchased another property in another state, for example, or even within the same state.
No, you can't. But what you can do, for example, is you might be move away for work or other circumstances for a period of years. As long as you can't return to that property and live in it and make it your principal place of residence again, you can then go and start your 6 years again. So maybe your circumstances in life or lifestyle dictate that you need to be in various locations over the years.
Yep.
You can keep exempting your principal place of residence for quite a while.
What if you did already own investment properties? Does the 6-year rule not apply to you?
No, because they're investment properties, it still applies to your principal place.
So that doesn't stop you from buying an investment property elsewhere through that process, as long as the principal place of residency that you're living in isn't currently owned by you.
Yes, spot on.
Oh, gotcha. Oh, it makes sense. Land tax.
Oh, no.
Land tax. This is a hot topic at the moment, and of course, there's a lot of conversations with people in relation to investors who are contacting us about they're looking to get out of the market or they're frustrated to get into the market because they're worried about the land tax and so forth. Talk us through what land tax is, how it's applied, how much it costs.
Absolutely.
Sorry, it's a lot to cover, I know, but
No, happy to cover it. And look, this is the area we are fielding the most questions for in the last 12 months.
Yep.
And it all comes back to up until recent times, there was quite a high land tax threshold. And I'll go into explaining what that is, but let me just say this, that due to the Victorian, the debt taken on during COVID, there's now a levy in place to repay that debt. One of the areas that this levy applies to is land tax. And that's why this has become a very topical issue, because it's gone from impacting only a few to really impacting the majority of property investors. Now, let me explain how it works. So what happens is essentially anywhere from $50,000 of land. So if your principal place of residence is exempt, but if you've got an investment property, if the value of land is $50,000 or more, you are going to fall into the land tax scheme in Victoria.
right.
Which is a very low threshold. You're really not seeing land.
So it's pretty much everyone.
Everyone, yeah, correct.
Now, this means that any land that you own outside your principal place of residence, and I guess this applies to people on rural lifestyle properties that have more than 2 hectares or 5 acres. Would that sound about right?
There's specific exemptions once we get into prime production land and that type of thing.
Okay.
So conversation today will probably just stick to the residential everyday land, because there are so many nuances to this.
Yeah.
Fair enough.
And okay, so the typical scenario we see, of course, is anyone who owns units, 1 or 2 units. The large percentage of mum and dad investors, they own one investment property. They're going to incur a land tax bill if they haven't already been receiving one. They're going to incur another one. Is it the same? Is it just the threshold that's changed, or has the tax increased?
Look, there's a bit of both, and I'll take you through a couple of scenarios. And keep in mind, with land tax, it very much depends on how you own the property. So if mum and dad own it jointly, right, that means they've both got a $50,000 essentially threshold exemption. So there's $100,000 of land before it's impacted.
And the threshold is important because it's only taxed on the amount above the threshold. Is that right?
That's right.
Okay. Yep.
So that's the first thing to keep in mind. Now, let's use a common scenario for the threshold between $300,000 and $600,000 of land, because typically, if they own 1 or 2 properties, if they're standalone properties, we've probably got $300,000 to $600,000 worth of land across that. The way that would work under that scenario is the amount of land tax with, say, 500,000 of land, just to pick a figure, they'd be paying $1,950 per annum. If that was just one person owning it on their own. Obviously, as a couple, it gets a bit lower. Use a smaller scenario, though. Let's say there was $100,000 of land. So pretty common scenario. If there's a couple, so 200,000 in total. There's 975 a year they're going to pay. The other thing to mention too is a number of our clients own land in family trusts.
Right.
Now, the reason they do this is because they view their investments, and when I say land, I'm talking residential property, they view their investment as being intergenerational. This might be something that in time they pass on to their kids. With discretionary family trusts, they get taxed from $25,000. So basically everything is covered. Give you a scenario there. If they've got $500,000 of land value in there, they're going to pay $3,588 a year.
Wow.
So it's substantial.
And is that because of the entity structure that
yeah, that's right. Yeah. So there's also
they're essentially trying to sort of discourage people from owning property in trusts, essentially.
Yes, they don't like the nature that a trust gives discretion as to who longer term can own it. Obviously, there's a lot of upside with trusts, taxation and otherwise, that is why you would use them. But in the last 12 to 24 months with these changes, we're seeing some real considerations there around owning the properties with this type of land tax.
Rather, are there benefits to owning property within a corporation, a proprietary limited entity?
Absolutely.
Okay.
Yeah, longer term, I mean, a proprietary limited, a private company limits tax to 30 cents in the dollar, which for high income earners can be a real bonus. The other side with the company, though, is it doesn't allow the ability to hand over control to the next generation without incurring stamp duty, which may be available in a trust.
And what about self-managed super funds? Because there's quite a few people who have purchased property in their self-managed super funds. Same sort of scenario. Are they treated similar to a discretionary trust, or are they?
They're just treated similar to an individual.
Similar. Okay.
Yeah.
All right.
I think the main thing with land tax is just to understand all land holdings that you have in your name or in your investment company, trust, super fund is all going to be aggregated together for each of those entities. So it's just being mindful that when you're going to purchase that next investment, getting professional advice before you do to say, where shall I put this? And consideration of land tax, income tax, and just your long-term plans, really important.
Okay. All right. I can sense the eyes glazing over from some of the people who are probably listening, because it's such a heavy topic to sort of get into, and of course that's why it's important to sit down with someone who knows what they're talking about. Okay, do we sense from a longer term perspective any potential changes to the land tax scheme down the track? Because we've seen a few new taxes get introduced, and we'll talk about those in a couple of secs. But is there on the basis that the state government is looking to try and recoup some debts on some costs and so forth, and we won't get into all of those decisions previously, but do we sense that land tax might have some further ratcheting up down the track?
Yes, well, I think if you look at it at a state government level, some of the biggest drivers of their revenue are stamp duty. So obviously the purchase of the properties, and some of the other ones is the land tax. So yes, it's one of the simplest levers they can pull, which they have to try and recoup some and pay down some of this debt. So yes, I get a sense it's certainly one area of exposure that could be adjusted.
So it's important to have these sort of contingencies in your acquisition strategy, and making sure that you're thinking about these things when it comes time to acquire investment properties down the track. So
yes, absolutely.
All right. Let's cover off a couple of new taxes. Vacant land tax. Now, this was on the horizon for a while, and then suddenly it was here. But I think it's been applied to metropolitan Melbourne for some time, and now it's been applied across the whole of Victoria. Is that right?
That's correct.
All right. Now, the name vacant land tax suggests something that is a little insidious, and that is that anything that is vacant has tax applied, but that's not actually the case. Is that right?
That is correct.
Right. So, and a collective, thank God, from everybody.
Yeah, correct.
Yeah. Okay. Let's unpack this and
Yeah, absolutely.
Thanks.
So the vacant residential land tax is a little bit deceptive by name insofar as it's not land itself it's applying to. It's more the notion that, and the reason it was put in was to try and encourage people to not have properties that were sitting there non-rented or non-available for rent, just to try and help with the housing shortage. So the way it works is it applies to existing properties, properties under construction that have been under construction for longer than 2 years, and potentially properties that have been uninhabitable for 2 years or more. So that's a pretty wide, that encompasses a lot of properties. But this is the bit where you can sort of breathe a sigh of relief to a certain point, is the property has to have not been lived in for at least 6 months in the prior calendar year.
Okay. All right. What if, so here getting in, I don't want to get too deep into the weeds, but I just, take, for example, a property that might be, all right, it's owned, let's say a relative has passed away and they've gone through probate. The family's trying to work out what to do. Maybe there's a little bit of, going to-ing and froing in relation to what to do.
Yep.
Does at the end of the calendar year, if the property's still been empty and the family, it's sort of transferred into the names of the people within the will, does it apply to them?
Yes, well, this is where the 6 month rule may catch them, because it's likely it hasn't been lived in for 6 months.
Yeah, I know people have had houses empty for 2 years waiting to work out what they're going to do. And so it's, because it's a different decision because it's, it's impacted by emotions and all sorts of different things. So.
Yeah, it's not just a financial decision. What I'd say too, Stu, is that 6 months you live in, it doesn't have to be a continuous 6 months. So let me just cover off on a few of the basics because it'll help clear it up a little bit.
Please.
So look, who can live in it to not be caught with this? It can be the owner. It can be someone that the owner permits to live in there. So this is probably a more unofficial tenant, I guess, so family, friend, someone like that. Or it can be rented out. As far as applying in Victoria, it's 1st of January this year, so 2025 onwards, it applies to all properties.
Is it retrospective? So it's the previous calendar year that it's applying to in terms of the vacant period?
Yes. No, it's going to apply going forward.
Going forward. From the 1st of January this year.
It's this calendar year we're looking at. So we've got time to make decisions around it and take action. A few things to keep in mind with this is it works on the capital improved value. Now, what does that mean? So we've been talking before about land tax, which land tax is, as the name implies, just on the land value. Capital improved value is the nasty one because what we're talking about is we're talking about land. We're talking about the improvements, the house, the shedding, all that stuff. It's a much higher value. And the way it works is that this ratchets up over the years that you keep it vacant. So year 1, 1%, capital improved value. Year 2, 2%. Year 3, 3%.
Okay. Just so I understand that. So if, for example, someone has a property that's vacant for 12 months, they pay 1% of the capital improved value. So when you look at your rates notice, you look at your capital improved value, and let's say it's $800,000.
Yes.
And you'll pay $8,000.
Correct.
All right. If you keep that vacant for another 12 months, instead of paying $8,000, you're paying $16,000, although the value has probably gone up to, say, $850,
correct,
according to the council. Now, that means that you're going to pay 2% on $850.
That's $17,000. Yeah.
Right. Okay. So it is there's a fairly heavy incentive to either, I'm presuming, sell that property or rent it.
Yes, absolutely.
So as soon as you rent it, that vacant land tax doesn't apply.
Yes, correct. Spot on. And that was the intention behind it, is to try and drive people to action. Because if using your scenario of 800,000, in year 3, it's 24,000. It's a very substantial amount of money.
It's cheaper to sell it, folks.
You heard it first here.
Yeah.
But what I would say to you is there's a few things to keep in mind. And I won't go through a lot of them, but one I want to touch on is holiday homes. Because we're noticing around the state and certainly down in the Mornington Peninsula, there's a lot of sales of holiday homes going on for this exact reason. However, there are exemptions around it. So as long as you use your holiday home for 4 weeks or more a year, you can access an exemption. There's particular criteria, but broadly speaking, you can access an exemption at that point. So that's really important with your planning.
Who determines whether it's been used for 4 weeks? Is that self-assessed?
Yes, exactly. Self-assessed.
Yep.
And that's thanks for bringing that up because by the 15th of January on the following year, every year, you have to self-assess and you have to notify the State Revenue Office. So it's very quick reporting deadlines for this.
And what's the trigger for that reporting? Do they send you a notification?
No, not at all. You've actually got I think there'll have to be an education campaign around this because the everyday person's not aware of exactly how this works. It's a complex area.
Right.
And yes, come the 15th of January next year, a number of people will be included in this system.
So I imagine if you have an accountant, for example, you guys would have triggers within your networks and systems to make sure that your clients are made aware of that situation. So make sure you have yourself a good accountant.
Yes.
But if you're doing your own tax, you need to be mindful of that deadline of the 15th of January. So I presume there are potentially penalties.
There are penalties, and they differ depending on, intentional or accidental oversight and a number of other factors. Just one other thing I'm thinking about, Stu, is this going to be expanded? Because once again, we're talking about reducing estate debt and a number of taxes applying to do that. What we're seeing is in Metro Melbourne from the 1st of January next year, 2026, unimproved residential land is going to have this tax applied.
So that's vacant land.
Vacant lands.
Yep.
So one of the biggest areas of potential expansion is if that is expanded statewide, could be a real impact on a number of...
Could be ugly.
Yeah, absolutely.
That could be really ugly. So the potential implications of that is that all of the blocks of land, the residential, let's call it the residential zoned blocks of land within places like Ballarat, Bunnigal and further adrift, could have a land tax, a vacant land tax applied if there's no improvements made to that particular property. So land banking becomes could become a very expensive proposition.
Oh, absolutely. Yeah. So that's one area where, while there's no indication they'll do that at this point, the fact that they're rolling that out in metropolitan Melbourne is always a bit of a precursor to potentially expanding in a regional sense.
All right, so because land sales right now are fairly slow, so it's an impost that could potentially have implications on the price of land.
Yes,
either in if there is an introduction of this, if land sales haven't picked up, it could potentially drive prices down quite heavily, so that there is a liquidation.
Yes,
of those assets. But down the track, it could also have an implication in terms of the increasing the cost of land to cover some of those costs for developers or landholders and so forth.
Yeah, spot on.
Wow. Okay. But let's not get doom and gloom, because we don't know that that's necessarily where it's going to go. But it's let's have our eyes on the horizon, so to speak. So, all right. Now, windfall gains tax. This is something that I think a lot of people don't know about. And this was introduced, forgive me, I think it was not last year, but the year before. Was that?
Yeah, July 23.
Last year.
Yeah.
July 20.
Yeah.
July 23. Yeah. Okay. Yeah. So explain what windfall gains tax is and when it's applied. Sorry to do that to you, because it is I know it's complicated, but for the sake of the listeners, let's try and break it down to as simple as possible. And then we'll talk about what the exemptions are, because we don't want to spook people with this, but it is something that people in the outer regions and particularly will need to be mindful of.
Yeah, absolutely. So, well, let's start really high level. Why was this brought in? It was all about the state government being able to access part of the gain in land. So when land's taken from essentially a very low density, maybe a rural zoning, and it's rezoned to a more residential or development ready zoning.
Okay, take the Ballarat West employment zone and take all the growth areas out the western side of Ballarat.
Yeah, correct. Yep, that's right. So things like that. The state government thought it was only fair that they could take a share of that. Which we won't debate that, but however, that is how it works.
That's another podcast.
Yes, I know. Yeah, it's a,
go on.
So what happened there? If I can just run the listeners through a few rates and how it works. Essentially, if the uplift is over 100,000 but under $500,000, so this is when I say uplift, I'm talking about the value before the land before it was rezoned versus when it has been rezoned. If it's between 100 and 500,000. There's 62.5% of that uplift that's payable to the state government.
Let's just repeat that for a couple of seconds.
Yes.
So if it's between 100 and $500,000 in terms of the value of the land at the time it was rezoned.
Yeah.
So before it was rezoned, so, midnight the day before, 62% of the increased value directly as a result of changing the zoning is payable on the uplifted amount. 62%.
That's correct. 62.5%. Yep.
The profit.
Yes.
Okay, so if the property goes from $500,000 to $1 million, you're paying 62.5% of the $500,000
That's correct.
left.
Yes.
Scary thought?
Very scary.
Okay, but now that we've got the scary bit out the way, let's drill down on that a little bit further, because there are some exemptions to that. And,
absolutely.
And it could, there are some factors that it might not necessarily impact everybody, and you don't have to pay it straight away.
No, so let's just talk. There's two rates. 62.5% we've spoken about, and then the next one is 50% if the uplift is over $500,000. However, it's taxed on the full uplift. So if you've got a $600,000 uplift, it's 50% of that, $300,000. Now, let's talk about how this works. Your land's been rezoned and it suddenly applies to you. You've got three options. You can pay it now, but keeping in mind you probably haven't sold the land at that point, so that's a lot of money to go out. You can pay part up front and then have basically a 30-year payment alone with the state government. They'll charge you interest like a bank would, or you can defer it for up to 30 years and pay the interest at the end, with the idea for some of these scenarios, if the land's been rezoned, it would potentially be sold in a somewhat short period of time anyway.
Yeah, and I'm presuming that the reason that they're going through the process of rezoning is deliberately to try and encourage development of some description. Typically, yeah. So those parties that tend to say, oh, look, I don't want to sell my land, I want to hang on to it and so forth, they're going to get charged this, even if they choose not to sell their property.
Yes, unless one of the exemptions applies. That's exactly right.
Let's talk about some of those exemptions.
Yes, so let's go through one of the most common, which is if you've got a property that's primarily used for residential purposes, so you live in it, up to 2 hectares, which is 5 acres, you're exempt. So that's a good one for your lifestyle properties that you mentioned earlier. From there, there's things around to go from a rural zone to, say, a green wedge, rural conservation zone, farming zone. There's these type of things where if you're just getting moved to a different rural zoning, there's exemptions around that, which is good. If you're near one of the urban growth zones, the government's got specific taxes that they levy on developers around those zones. So potentially your land is exempt from paying this tax because they know they're going to be able to charge the developer a contribution tax for that. So that's how it works. I think it's just being mindful of it, how it may apply to your circumstances.
Yeah. Okay. And of course, when it comes to rezoning, is this something that generally they project out that this is what they're planning to do in terms of count the hours? And this is council, do council rezone, or is it more, this
depends on the scale.
Depending
on the scale. So on a small scale, the council would be rezoning. Sometimes at a state level, the minister will become involved, and if they're talking about a very large growth zone, the minister may become involved to push that through. I think the other thing to be mindful of now that this has come into place is for those people that are looking to potentially sell their land to developers, they may find that the developer's happy to offer them a contract to purchase it, but it might be a much longer agreement because essentially they won't want to actually settle on the land until it's really ready to be developed.
Yeah.
They're not going to sit on land like they might have in the past because there's all these extra taxes.
Yeah. Okay. So they're waiting for the changes to occur so that they can actually turn that into cash quicker,
as quick as possible.
Yeah. Gotcha. All right. Sounds good. So the last thing I just wanted to cover was, have we sort of covered everything in terms of
I think so.
Okay. And again, folks, just speak to your accountant, a professional who sort of knows what they're talking about in this space and understands your circumstances more intimately. Stamp duty exemptions. Now, this is something I get asked about by people who are downsizing quite a lot.
Yes.
Fill us in on what those are potentially for people who either might be, first home buyers or potentially coming from a much larger residence down to a smaller place.
Yeah, okay. No, good question. And what I'll say with stamp duty exemptions is I'm gonna name some of the exemptions that apply. get specific legal advice on these. And it's a bit like the windfall gains tax. Whenever we're talking about something which is fairly specific, it's state-based, you're better to get the legal advice on it. So stamp duty exemptions, what applies? Well, look, we've got the first home buyers, which, under $600,000 property value, there can be basically a full stamp duty exemption. And then there's a shading in between 600 and 750.
We're talking regionally here, aren't we? Like, is there different rules for different locations?
Depending on which sort of form of property you buy. So, for example, a lot of people would have heard about the changes to the off-the-plan purchases, which has been brought in Melbourne to try and really spur on the development of the high-rise and the multi-tenancy buildings. So that's another one, the off-the-plan exemption, which dramatically reduces the stamp duty, essentially just to the land value rather than the building itself. Yep. Pensioners and concession card holders, exemptions around there. There's certain things there for young farmers. There's a lot of different exemptions. These fairly specialised.
Yeah.
And what I'd say to you is, if someone's looking to, as you say, downsize, buy their first property, do some research into your particular area. There's a lot of information online. And if you're at all uncertain, go and see your legal practitioner and get them to give you some advice.
So it's more your conveyancer come a specialist solicitor, a property solicitor.
In this area.
Yeah, exactly. All right. So accountants are not necessarily the best people to provide advice in that particular area. It's more so the legal profession.
Yeah, that's right. Like, we're across a lot of the rules. However, from a standpoint of who should provide the advice, the legal profession are the ones that you give specific advice from.
Yep. Not necessarily your real estate agent. Well, we've covered a lot, and there's probably a lot more that we could drill into. I think this has been a fairly comprehensive yet high level conversation around taxation and the various areas that it applies. Thanks again for coming in, mate. I really appreciate it.
Yeah, no.
It was an early start for us this morning, but it was good to get it sort of the way. And if you have any questions, people can kind of reach out to us, and we'll be happy to answer those as best we can. And I'll make sure that I put your contact details in the show notes so that people.
Sounds good.
All right, mate.
Thanks, Stu.
Appreciate it.
Cheers.
Take care. If you have a friend or family member that you feel might benefit from some of the information that you've just heard, then it would mean the world to us if you could share this episode with them personally. Oh, and one last thing before you go. We have some really interesting topics planned for the upcoming episodes, so if you have any comments, feedback, or real estate topics that you'd like covered, I would love to hear from you. So please reach out to us via email, which is info@regionalproperty.show, or leave us a note in the comments section. Don't forget to hit the like and subscribe button to be notified when new episodes are released. I'm Stu Bryan. Thanks for listening.